Most people think they understand venture capital. They've heard the stories, watched the movies with founders raising millions on billion-dollar valuations, that one investor who turned $75,000 into $300 million. But here's the part most don't get. Venture capital isn't just money, it's a system, one built on risk, exclusivity, and access. In this episode, we're pulling back the curtain on the money that fuels these private deals, how it actually works, who gets to participate, and why it shapes more of your life than you realize. Before we get into how venture capital actually works, let's clear something up, because a lot of people confuse venture capital with things that it isn't. So first off, it's not the public stock market. It's not commercial lending. This isn't bank loans going to private companies. And it's definitely not something most people ever get access to. In fact, less than 5% of Americans have any venture capital in their investment portfolio at all. But about 60% own at least one share of a public company. Think Apple, think Amazon, think Johnson & Johnson. So let's start there. What venture capital isn't. I was recently reminded that most people don't really understand venture capital, or at least how it's different from the public markets. I got into a dumb Threads debate with someone that wanted to talk about how this AI bubble was going to destroy 401ks. And when I pointed out that most of the overvalued AI companies that are represented by this bubble are private, I got a bunch of pushback. Like, they didn't understand the difference, and like, well, yeah, that's fine, but they do these deals with Oracle and NVIDIA and all that stuff, and that's where the bleed over happens. And they're right. There is going to be some knock-on effect, but it's not going to be something that absolutely crushes public markets when people finally realize that OpenAI may not be worth 40 times future revenues as far as a private valuation goes. So let's just start by setting the record straight and define VC. So venture capital is represented by investors in investments made into privately held companies. Again, not Apple, not Amazon, not Johnson & Johnson. It is a specific segment of private equity. And private equity is represented by non-public transactions. It's kind of in the name. That includes investments, mergers, and acquisitions of non-public companies. Again, privately. Venture is unique in that it has been traditionally the riskiest kind of private equity. 3 out of every 4 venture-backed companies fails, and only a small segment of those that don't fail actually become highly valuable. It's supposed to invest in the most promising startups with the highest growth potential. We talk about this term called venture scalable, meaning that this is a company that will grow beyond a traditional growth company, or at least at a rate that exceeds a traditional growth company, or certainly a mature company. Think hockey stick graph, up and to the right. But they're very risky, and so they're big bets and there are big fails. There's a lot of risk and a lot of reward, and sometimes that's asymmetrical. I hope you're enjoying the content, and if you are, please consider subscribing to the channel. Back to the episode. So if this all sounds horrible to you, let's talk about why people actually invest in this asset class, in venture capital. In simplest terms, it's returns. You're more likely to turn a small investment into a huge investment than in the public markets. Could you see a 10 to 15% return on your Johnson & Johnson stock in 1 year? Sure, you could. But it probably isn't going to happen every year, and it certainly won't happen consistently. Venture investment is just that. It is a big bet, huge risk, hopefully for huge returns. But the likelihood of that VC investment going to zero is far higher than a publicly traded company. Just like you can't see massive returns in a Johnson & Johnson, they're probably not going out of business anytime soon, or at least not in the next 12 months. In venture, not only is that possible, but it's probable 75% of the time. The example I like to use on this is Mitch Kapor, and he's a great example of the power law. And I'll talk about the power law in a second, but Mitch put $75,000 into Uber as an angel investor when it was still a private startup. When Uber finally went public years later, Mitch's stake was worth $372 million at the IPO. So that's, for anybody doing the quick math, that's 5,000 time return. You're just never going to see that in that same period of time in the public markets, or at least you're not going to see that often. This is a feature of venture. It's not a bug. This is what every venture investor is trying to do. Now, that power law I mentioned just a second ago is well represented here. Make no mistake, Mitch made a lot of investments that went south, but you only need a few to break out to demonstrate that power law. So your returns are usually sequestered into only a handful of companies. So if you make 100 investments, maybe 10% of them, maybe 20% of them actually return a profit to you. Now, they can do that in such a way that pays for all the losses of all the other companies that you invested in that didn't make it or that went to zero. Even in a typical distribution of a venture fund, you'll see kind of a third, a third, and a third. And that's shorthand for a third of the companies will go completely to zero and out of business, right off as an investment. A third will kind of be going concerns, but aren't really venture scalable, aren't really going to go anywhere, and eventually go to zero as well. And then a third overperform or outperform the fund. And in that third, in that 33%, in that 25%, whatever it ends up being, that's where you see all the profit go back to the investors. Most VC investors are also traditional public securities investors, so think S&P 500 indexes, all of that as well. Very few people are venture-only investors. So they only risk a small amount of their total investment portfolio on venture. It might be 5%, it might be 10%. And you're going to see periods of what's called rotation into and out of venture based on public market returns, volatility, or other factors. So basically, investors will move in or out of venture and in or out of public securities as a function of how much money they can make in the public markets. In my opinion, how much money that is flowing into or out of venture at any point in time is a reflection of what is the total alpha available in the public markets right now. Are they sluggish? You're going to see more money moving towards venture with higher risk, but also higher returns. They can get more for their money, put their money to work in a more efficient way. And then conversely, the same is true. If the public markets are cranking, there's really no reason to take your money out of that into venture, which again, much riskier over the short and even medium term. It begs the question, how does any of this venture investing work mechanically? Well, there's nuance to this, but basically two ways to invest. First, you can invest as an individual, or you can invest as an entity. So think LLC, corporation, etc. The second one is that you can invest as a limited partner or LP through a venture fund. That begs a question, what's a venture fund? Well, it's basically set up like any other business. There's a general partnership, either as an LLC or an LLP. It's usually run by a registered investment advisory firm, and the LPs are members of the GP, the general partnership. That GP is the entity that actually invests in the startups on behalf of their LPs. So think about the LPs come together as an entity into this GP. The GP is an independent operator. The LPs, or limited partners, are participants and have ownership via their pro rata amounts of investment in that general partnership. So once that GP is formed with the LP's money, they go out and they try to find deals. And so the next step is that the investors, that GP, and that startup, whoever they have decided to invest in, they agree on terms for the deal. Those terms can be really simple or super complex just based on their circumstances. Early stage deals tend to be really simple, very straightforward. The amount of money is lower. The complexity of the deal is also much simpler. Get into later stage stuff, a lot more complicated. And I'm not going to bore you with the minutia of all of this stuff, but the investors, the VCs, then give the startup cash in the form of investment capital, and in return get an equity stake or at least a claim to equity in the future. Again, I'm going to spare you the boring details of debt versus equity deals, but investors are either getting ownership, equity, in the company now, or they structure debt that will convert into ownership in the future. Not always. Sometimes there are straight debt deals. Sometimes There's just interest accruing on debt that they have to pay back. But usually that debt is convertible because it's bigger upside for the investors. So the startup then uses that capital to grow and hopefully continue either raising venture capital or growing revenues until they're either purchased, they merge with another company, or they go public via an IPO. Those are called liquidity events, meaning everyone finally gets paid. Something to understand that is very different about venture investing is once you make that investment, you don't have access to liquidity nearly the same way you would in a public market. If I bought 10 shares of Apple at 9:30 a.m. on a Tuesday, and by 2:30 p.m. on that same day I wanted to sell it, I could. If I make an investment in an early stage startup, I may not have access to liquidity for 5, 6, 7, 8 years or more. Even if there were what are called secondary transactions, which is private investor to a private investor, or private entity to private entity, or investor to investor, where I'm just basically selling my shares to someone else in a secondary transaction, even those are kind of hard to put together. And so once you make these investments as a venture investor, it's pretty locked up for a real period of time. But when they're successful, the VC investor's equity does become more valuable. And when a liquidity event finally happens, that's when they realize a profit on their investment. So they either get bought out by the acquiring company. If they merge with another company, usually there's some sort of exchange of stock or cash or some combination of that. So there's a liquidity event wrapped in that. And then obviously if they go IPO and they go into the public markets, then that becomes publicly available, publicly tradable, and you can create your own liquidity event depending on when and how much of your shares you want to now sell on those public markets. I opened up the episode talking about access, and it's important to understand that access also reflects who VC investors are. And most of you would guess, or you already kind of know, that individual billionaires and hedge funds are obvious examples of VC investors, but a lot of people don't realize that LPs and venture investors also include university endowments, pension plans, and even sovereign wealth funds. It may or may not be on your radar, but the Saudi Sovereign Wealth Fund is massive and has been very active over the last decade. Right now, they claim to have $1.15 trillion in assets, and the majority of that is in venture investing. CalPERS, which is California's public retirement system, takes their dues and then reinvest that to try and multiply the money. Understand any retirement system has to make more money than it takes in because it has to eventually pay that out over time. You have the cost of money, you have the rising interest rates, you have inflation, all of those things have to be taken into consideration. So these public retirement systems are huge investors in private equity. CalPERS is the biggest. It currently has $98 billion in private equity assets. And then Harvard is an example of an endowment that is heavily indexed in private equity and venture. The belief is that at any point in time, about 30% of their $52 billion endowment is invested in some sort or some form of private equity. So you may have heard this term accredited investor, which is what you have to be to participate in any of these venture deals, whether it is as an individual or as a LP in one of these funds. Well, what that means is that you have a net worth exceeding $1 million that excludes the value of your primary residence. Now, you can hit that threshold individually or jointly with a spouse or partner. Or you have an annual income of over $200,000 individually or $300,000 combined with a spouse or partner for each of the past 2 years with a reasonable expectation of maintaining that income in the current year. If you're reading between the lines, you're going to realize that a lot of this about being an accredited investor or an accredited individual is tied to you just saying that you are, attesting that you are. It's not perfect. And there are some professional and licensing exceptions as well. If you have a Series 65, if you have a Series 7, if you are somebody of consequence within the organization that you're investing in, there are loopholes and there are exceptions outside of that income or personal net wealth. How big is venture capital? Well, the US alone invested $209 billion into venture in 2024. By comparison, $10 trillion was invested into public stocks in the US in 2024. Now, that's a bit of an unfair comparison because when you calculate how much was invested into public stocks, a lot of that is recycling of assets, recycling of investments, recycling of capital. And so that's the total volume that goes through there. But if you look at the net new investment into the US public markets, that was around $900 billion. So as you can see, given that VC is almost always new money in, you can see that that form of private equity matters in the grand scheme of things because it's a real percentage of the total amount of money being invested in companies, either publicly or privately. And it's not just about the percentage of total investment in companies in the US. VC matters because almost every high growth tech company started with some sort of venture funding. Name any tech company that is of consequence right now, and almost every single one of them took some kind of private funding, some kind of venture capital. It's actually a core reflection of what makes the US economy so unique and resilient. If you look at venture capital activity outside of the United States, you're gonna realize pretty fast that we risk capital at a much higher rate than other G7, G6 companies. Scott Galloway has an interesting take on this because he says that this country was founded by the risk takers, the ones that left their countries of origins, the people that immigrated here for a better life, for more opportunity. Maybe they had no choice and they needed to come here. But the core of that is that risk is baked in potentially to our DNA as a country. So the basic idea of venture capital as an asset class feels very American. And venture capital certainly has its downside. There's an argument it's another vehicle to hoard wealth and opportunity among the wealthiest and most elite of us. VC investment itself has historically not been available on the same terms and basis for female founders or founders of color. The disparity there is stark, and that canyon is incredibly wide. VC is also very cyclical. It's heavily reliant on the overall economy and public market conditions. As I said before, if the public markets aren't moving well, VC tends to see a bump. Public markets are doing great, VC starts to see a pullback. There's increasing concern that consolidation of funds is building a tinderbox for burning investor capital. We see a lot of investment going into fewer and fewer mega funds, which in turn are investing in fewer and fewer mega deals, and all of that consolidation is starting to look pretty fragile. As you might guess, I have a lot of opinions on venture and its current state of affairs, but I'll save that for a future episode. I will give you a couple of quick hits though. So VC, in my opinion, has been acting far more sheepishly over the last 2 years than at any point prior to 2010. I think their risk tolerance has gone to damn near zero, which is ironic because that's the entire basis for the asset class. It's frustrating, especially for early stage founders who are finding it hard to raise that seed round or even that A round because now you have investors that are really slow to pull the trigger, not acting with a ton of conviction, and frankly, being pretty sheepish. As I said before, venture tends to be cyclical. So whatever's happening now may not be happening in 6 months. That could be good, that could be bad. If things are really good right now, they may not be that good in 6 months. Conversely, I think there's reason to be optimistic that the next 6 months we're gonna see an overall improvement as capital appears to be moving again. It's sluggish, and it's still a tough time to be an early stage startup trying to raise capital. But you can bet on the cyclical nature of venture capital to change potentially dramatically over the next 6 to 12 months. So to kind of wrap this up, venture is a specific and important asset class. Without it, we wouldn't have nearly the tech innovation we've seen in the US over the past 3 decades. There's a role for venture to play in our markets, namely in private markets where risk capital is required to fund companies that aren't yet commercially viable. They can't get a bank loan. They need venture. They need that seed capital. Venture has changed. We see far too many venture funds acting like commercial lenders. See above the sheep. Venture is not inclusive of everyone, and it does continue to be biased. It's clubby, and and it's full of like-me bias. Greedy mega funds are raising more capital than they can responsibly deploy, which puts the entire asset class at risk. And at its core, venture is a tool that can be utilized to fund and grow the riskiest of bets and to build technology. Venture capital isn't just a pile of rich people's money chasing the next Uber. It's a reflection of how we, especially in the US, reward risk. It's messy, uneven, often unfair, but it's also the reason we have innovation at the scale we do. Without venture, there's no Apple, no SpaceX, no OpenAI. But when venture forgets what it's for, when it turns into a game of hoarding access and wealth instead of betting on ideas, the system breaks. The irony is, venture capital started as a way to democratize risk, to give bold ideas a glimmer of opportunity. Somewhere along the way, it got exclusive again. Maybe the next evolution of venture isn't about more money or bigger funds. Maybe it's about getting back to what made it powerful in the first place. People willing to take a risk on something that could actually change the world. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.